Hello, everybody. I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar. What are you doing about regulated stablecoins? We're asking this question in the wake of the publication of our Future of Finance paper on the topic of stablecoins, entitled Stablecoins, Where They Came From, Where They Are Now, and Where They're Going Next, which you can download from our website. It looks at how stablecoins are being regulated and what the consequences of that regulation might be. And it was the global consensus on how stablecoins would be regulated and what that meant for the future of money, which drove the discussion when we last visited this topic back in January this year. Since then, some banks used by stablecoin issuers have failed. It's also become more obvious that rising interest rates have made the search for yield in stablecoin reserves rather less risky. And tokenized deposits, above all, have emerged as a conspicuous alternative to stablecoins, and one even more tightly bound to the traditional banking system, with its privileges as well as its obligations, than a regulated stablecoin. So stablecoins and their alternatives, the future of money, you might say, remain a lively and rapidly changing topic. That said, some issues haven't changed at all. Central banks are still worried about what these new forms of money will do to the funding of banks and their consequent ability to manufacture credit. Regulators continue to believe that digital money can make payments, especially across borders, more efficient. And the question of how all this experimentation will eventually settle down into a new monetary order fit for the digital age is a question still worth asking, if only because it's only the passage of time that will give us a final answer. To help us explore these recent events and the various lines of progress into the future, we're joined by 4 experts in the field of stablecoins, who I might say are eager to answer your questions as well as mine. Ricardo Correa is Global Head of CBDC and Digital Currencies at R3, where he and his team work with private and public sector organizations on the development of markets for digital currencies and digital assets. Gilbert Verdian is CEO at Quant, which is dedicated to making blockchain protocols and traditional systems interoperable. Keith Baer is a fellow at the Cambridge University's Centre for Alternative Finance, which is part of the Judge Business School, which he joined from IBM. Keith works with fintechs, exchanges, and central banks. Keith is also a member of the Bank of England's CBDC Technology Forum. Jeet Singh is EMEA Assurance Blockchain Leader at EY across all industry sectors. He's worked in all parts of the financial services industry too, including regulatory change, but especially in the wealth and asset management areas. As I just mentioned, our panelists are here to answer your questions as well as mine, so I encourage everybody watching or listening to submit questions and comments throughout this webinar by using the Q&A functionality at the bottom of the Zoom screen. I won't save your questions and comments to the end, but I'll answer them or put them to our panelists as we go along. The idea is that you should be an integral part of this discussion right from the outset. But I'd like to begin our discussion by asking about those failed banks I mentioned a moment ago. Stablecoin issuers found it difficult to persuade tier 1 banks to accept their deposits since they were tainted in some way by association with the unregulated cryptocurrency industry. So they ended up depositing some of their reserves at lower tier institutions, a number of which in the spring of this year fell over. So my question is that bad for stablecoins because they have forfeited a degree of trust, or is it good for stablecoins because the accident has strengthened the case for tighter regulation of stablecoins and indeed regulating them more or less as banks? Keith, could I throw that question at you first? Has the failure of these various banks, Silicon Valley, Signature, Silvergate, been good or bad for the stablecoin industry?
Well, first of all, I think it's bad for everybody who was affected by the failure of those banks, and we shouldn't lose sight of the fact there were a lot of people and a lot of firms that suffered significantly as a result of those failures. In the case of Silicon Valley Bank, obviously, USDC, iCircle, the issuer of the USDC stablecoin, had a significant set of deposits at SVB of the order of 3.3 billion. And as I think everybody knows, when Silicon Valley Bank failed, USDC lost its peg as a result, dropping to some 87 cents, I think, in the worst position. So obviously, it shouldn't come as a surprise to anyone, bearing in mind that stablecoins are based on deposits which are held in a number of institutions, or indeed other less liquid deposits in the case of some other issuers that may hold them in different types of government securities or high quality liquid assets, etc. So I think the failure of Silicon Valley Bank in particular raised the question as where the location of these assets are in terms of reserves and the stability of the reserves as a result of where they're being held in that respect. And as you mentioned, stablecoin issuers are frequently having to go to smaller banks who are willing to provide crypto services in that respect. I think the case with Signature and Silvergate was a bit more different in the sense that both those banks operated networks. So SEN in the case of Silvergate and Signet in the case of Signature, that were obviously significantly used by crypto firms in terms of being able to get in and out of crypto into fiat, etc. So that had a different kind of effect, I think, as well, because of the services, broader set of services that were provided to the crypto industry at large, as opposed to holding the deposits of a stablecoin. But to get back to your question, I think it does show into sharp relief the dependency that the peg of a stablecoin has is dependent very much on the nature of the reserves, the ability to redeem those reserves, especially at the time of crisis, and the speed that crisis unfolded gave a significant shock to the system in the case of USDC in particular, and therefore does, I think, raise questions and making sure that the risks associated with stablecoins by their very essence are well understood, and very much that's a focus of what we're doing at Cambridge at the moment in terms of building a digital money dashboard, which one of the things we're looking at is the composition of reserves, the attestations and the audits that take place to be able to confirm that in order to help better consumer and industry understanding of the nature of the risks they're taking on if and when they're transacting with stablecoins.
Now, Jeet, the point which Keith has just made about the composition of reserves has become a very familiar issue in, among other places, the money market fund industry. But what's your view of how this stablecoin industry is going to have to evolve in terms of the reserves, the transparency of the reserves, if you like, what the users understand of where the money is actually invested?
And I think, Dominic, you make a very interesting link there. And if we also look at some of the proposed legislation that's coming out with MiCA and what it says about stablecoins, and the UK proposed legislation as well, and what it says about stablecoins, as well as what's also come out from MAS in Singapore on what they are proposing as well, and some of the other global regulators, I think that link to me to money market funds is a pretty straightforward one, right? Money market funds as well nearly broke the buck when they did. Some of them did in the global financial crisis in 2008 as well, was exactly for the reason why Keith said, because there was lack of or reduced trust in what was underlying those funds, right? And I think that's going to be key here, Dominic, which is transparency on what's backing the stable coin. But I would also hope, though, that with these stable coins coming within the gamut of regulation in quite a few global financial jurisdictions now, the issue which you touched on in your introduction, which is the link of these stable coins currently to crypto and the challenge they might have at the moment to access banking, I would assume that would actually would reduce because they are now regulated. They would become regulated institutions or regulated products under the proposed regulation in quite a few countries. And for me then as well, the natural link to that is the audit and attestation point that Keith brought up, right? So how do we bring more trust to this area? How do we bring more attestations and audit to this area, to me is also really key. And just like how in money market funds, you've got the framework there, people know what they're getting into, people know how, what the process is. Hopefully this will also hasten that in this space to continue to build trust, sir.
Mm-hmm. Now, Ricardo, one thing we've learned from the history of money market funds is they do tend to fall to a discount no matter how much regulation you apply, and they did it again most recently in the beginning of the pandemic back in 2020. Everybody thought they'd fixed it after the great crisis of 2008 when a number of funds broke the buck, as it's called. What have we I think two questions for you, Ricardo. One is, and this is a sort of left field question, whether we've learned anything about maintaining pegs from currency pegs, actually, as opposed to money markets trying to retain their par value. My other question is, if we do make these reserves more transparent, are there going to be enough to go around? We've certainly seen banks scrambling for high quality liquid assets in a number of crises of late. Maybe that suited central banks who've been buying a lot of debt lately, but we're going in the opposite direction now and trying to reduce government debt and quantitative easing. Sorry, my questions got a bit jumbled, but currency pegs and asset transparency, are there enough?
Yeah, on currency pegs, certainly, I think there's a lot we can learn from currency pegs. Lots of similarities. I mean, first and foremost, you're trying to maintain a stable value relative to either currency or the asset itself. But there's a bunch of things to consider. So first and foremost, vulnerability to external shocks. Of course, we've seen some of that just recently. We've just talked about some of that. Economic events, market dynamics, and just mentioned kind of the regulation that's coming up in Europe and other countries as well, Australia and the US. So regulatory changes can certainly impact. And then the other issue around issuer intervention. So, you know, on the currency side, typically the central bank will intervene to maintain stability. So active intervention using things like, you know, the tools that they have at their disposal, interest rates, foreign exchange, FX and the like. On the stablecoin side, so, you know, managing the underlying asset becomes super important. There's various techniques and, you know, different stablecoins have different approaches to that. And then you get to confidence and trust. So again, similarities between currency pegs and stablecoins. So, you know, the confidence and trust of market participants and the stability of the peg and the asset. And so that drives a lot of the stability and things that we've already talked about, the transparency, the audit, the regulatory compliance of these things, I think is really important. So the user confidence certainly helps to maintain the stability. And then again, coming back to the regulatory and the legal risks around these assets. So currency pegs typically have faced regulatory and legal challenges in the past, and these are a lot more mature than what we see on the stablecoin side. They start to blend a little bit, but, you know, authorities typically impose, you know, certain controls, capital controls, restrictions, which could undermine the stability, but could drive stability. So, you know, these tools are important to kind of ensure that we use them appropriately, certainly on the money side and on the stablecoin side. So regulatory hurdles and legal uncertainties of stablecoins is certainly driving a lot of this instability at the moment. The other two things that I might mention, market liquidity and depth. So, you know, what is the liquidity or insufficient liquidity or depth could lead to price deviations and instability. Lower adoption, limited liquidity obviously will drive the kind of instability as well. And pegs could suffer from liquidity, lack of liquidity and lack of depth. So market stress and capital outflows is typically what we see there. And then, of course, you know, the big thing that we see between money and stablecoins is that the technology of stablecoins is very different, of course. It's a distributed digital context versus money and what we know today. So this introduces a bunch of unique characteristics and challenges on the stablecoin side. You could argue that, you know, blockchains and smart contracts, programmability and such can provide additional tools for stability, mechanisms for transparency, as we've seen. So, you know, there's a lot of promise in the technology. So certainly that's kind of that's driving a lot of the momentum around the innovation. And so, yeah, I think studying the history of currency pegs can certainly help us understand where we might go with stablecoins. So that's to your question one. I think to question two, which I think was, is there enough kind of assets to go around? I suppose, I mean, that really depends on the design of the stablecoin, the size of the market that you're looking to penetrate, liquidity and availability of the assets in those markets, and asset variety. The other things that you got to look at is regulatory considerations and then the adoption rates as well. So asset variety is important to consider. If it's a one-to-one peg, there's enough USD and EU to go around, I suppose, to give us the ready available kind of quantity that we need. But we also have stablecoins that are backed by baskets, you know, cryptocurrencies, commodities, and so on. So I'll just wrap up real quick because I've gone on a bit, but I think on the availability of the asset side, certainly the design is important. If it's pegged, a lot more liquidity or a lot more availability than we might find on a basket. So the liquidity in depth, the regulatory considerations also really important. Adoption also becomes really important, market adoption. And then, also to be clear that, stable coins and this whole space is still evolving. So, there's a whole bunch of different types of stable coins kind of emerging. So you really do need to look at the design and the fit for purpose of these things. So I'll stop there and pass on to any one of the panelists that might have something to add.
Well, I'd like to bring Gilbert in at this point. We've been talking a lot, Gilbert, about what the reserves backing these things are, about their variety, quantity, and a thought has occurred to me, which is that we've talked about withdrawal of quantitative easing, returning to more normal monetary conditions. Well, one effect of that is higher interest rates. And one of the things that was driving stablecoin issuers down the quality curve was excessively low interest rates. So they were taking more risks in their reserves. Now they don't need to do that. They're sitting there on, with central bank base rates at 4 or 5%. I imagine that some of these stable coins like Tether and Circle actually becoming rather profitable now without really having to take much real risk at all. Do you think, Gilbert, a specific question for you, do you think a cash-only stablecoin is now viable? We do have one actually in the sterling area, which has been launched, but do you think in the long run those are a viable option?
So according to the BIS, that there is room for stablecoins in the money flower, the famous money flower in the paper they did. And that also shows there's room for central banked digital currencies in the money system. With stablecoins, they're an unusual business model, because what you see is the pegging to 1-to-1 to the dollar or the pound or the euro. But what you don't see is the interest that the issuer keeps. So for Circle, for example, I mean, they're keeping the 4+% interest for themselves, and only flowing the pound or the euro or the dollar peg between the system. So it is quite profitable, and as interest rates, as we've seen today, they went up again in the UK, for example. It is an asset that can continue to be more profitable. But I think those types of business models are at risk, and what we're seeing is the introduction of central bank money, which is actually tokenized central bank deposits, and they don't carry any interest. So it'll be interesting to see how the industry picks the right type of stablecoin for different business models, but also for different types of use cases, and how consumers and businesses prefer to deal with different ones. But there is room for both within the financial system.
Thanks, Gilbert. Now, we've had a question from a member of the audience, which is an interesting one. It is, what are your views on the requirement of direct redemption rights directly with the issuer of a stablecoin for a bearer instrument like a stablecoin compared to a traditional store of value facility, e-money type products such as PayPal, which maintains customer accounts? Now, this either truncated or even non-existent redemption rights for holders of stablecoins that would go to an exchange and sell it if they want their money back has been quite a long-running issue in stablecoins. G, do you have a view which you could share with our member of our audience on this question, redemption rights in stablecoins?
I think it's a very, very interesting question, Dominic, to ask, because we've done some work in this space, and the devil is very much in the detail. And I would actually say that we've had some insolvency practitioners, partners involved, and legal people, and it's taken them a little while actually to undo or to sort of deconstruct where your rights exist, when your rights exist, how do you actually enforce the rights, and what access do you actually have to the underlying stablecoin collateral. So I think there's no general one answer fits all, but I think it's a very important question and a very interesting question that the attendee, your attendee has raised. The other point I would touch on is on e-money. I think there's an interesting, it's interesting that the person highlighted this sort of e-money link as well, because requirements on e-money holders, e-money firms, and not saying one firm is bad and another one is good in any way, shape, or form. But again, there's a lot of variety in the e-money space at the moment. We've had e-money firms also have a pretty tumultuous time in certain situations. And so I think it still boils down to to the point, which is, you need to do your DD, you need to do your due diligence, and you need to understand actually how your money is being held, be it in an e-money firm, be it in a stable coin, and what access and rights do you actually have. And I think a lot of people make assumptions about that, Dominic, but actually they don't realize potentially how exposed or not they might be, sir.
Although e-money has not taken off in large part because you have to be 100% cash reserved, and it doesn't make much sense for banks or indeed anybody else to issue them, particularly at interest rates which prevailed for quite a long time. We've had an observation really by Ian Hunt here, which is that are stablecoins that throttle supply and demand to maintain stability dead as a result of their exclusion from proposed regulations? If so, why are conventional currencies okay when they throttle supply and demand to achieve stability in just the same way? Now, I didn't even bother to ask you questions about algorithmic stablecoins, because it seems to me that they are more or less dead. And as Ian says, they have, for good or ill, been totally excluded from the regulatory measures being taken in all jurisdictions, and indeed through the FSB recommendations. They are outside whatever's going to be regulated. But of course, one type of, and you may have some, Keith, you may have some views to share with Keith on this comparison between algorithmic stablecoins and fiat currency. But I'd throw into the mix as well the fact that we do still have one algorithmic stablecoin surviving at quite a substantial scale, which is DAI, backed entirely by cryptocurrencies. It's survived. It's actually been relatively stable. It achieves that through over-collateralization. But does that tell us anything of relevance to Ian's point? Keith, do you have some views on this?
Sure, and thanks, Ian, for the question. I mean, I think not only is it regulation, which has been a big impact in terms of algorithmic stablecoins, but also it's the failure of failure of Terra itself, which has obviously made people very aware, I think, what the risks are associated with algorithmic stablecoins, and from that example. So I think for sure we can expect them not to have any significant difference, but it's interesting you equate DAI with an algorithmic stablecoin, because whereas it does use a supply and demand or an arbitrage mechanism in terms of maintaining its stability, it is at least backed by Ether or other kind of crypto or increasingly real world assets as well, which MakerDAO, the protocol behind DAI, are getting more and more into real world assets to reduce some of the dependency they have on crypto assets. So it is a backed stablecoin. And in that sense, it's very different, I think, to Terra, which obviously was not backed. It was purely managed on a supply and demand basis between the stablecoin and its sister coin. And I think the comparison Ian makes between those kind of algorithmic stablecoins and the traditional money system, I mean, the fundamental difference, of course, is in the supply and demand that is managed in the case of central bank money. It's the central bank doing that according to its mandate it has in terms of financial stability and monetary policy, etc. And being the backstop as far as the monetary system for the nation state is concerned. So I think it's fundamentally different in terms of trust associated with the central bank money because of the nature of the issuer and the basis by which the supply and demand is managed and the rationale for that on behalf of the nation state, as opposed to an algorithmic stablecoin with a private entity being responsible for that and all of the questions and risks that might just be associated with that aspect.
Now, I'd like to touch briefly on this question of regulation. It's dealt with at enormous length in the paper which we've published. I don't want to linger too long on it, but I'd like to ask some sort of relatively high-level questions of you about that. One of which is the question of standardization of the assets which back asset-backed stablecoins. Has the FSB done enough on that? I'm also wondering more generally whether what is being done here through the G20, the G7, the FSB, and so on, is this really just a sort of stopgap measure, or is this a permanent regulatory framework which we can expect to persist through time, because regulators are concerned that stablecoins could become very big and become a destabilizing influence? What do you think is really going on in the minds of regulators? And Ricardo, perhaps you could address that, and maybe Gilbert, you have some thoughts on that as well. But Ricardo first.
Yeah, thanks. I'm not muted. Thank you. So yeah, I think the FSB has been actively involved in examining the regulatory and supervisory implications of stablecoins. I think the big challenge is achieving a global standard approach to asset backing stablecoins. So that's the remaining challenge, and it's up to really the individual jurisdictions to implement some of the guidance there. So addressing the risks associated with stablecoins, including those related to the asset quality, certainly is a key focus. I believe the October 19 report, the FSB highlighted the importance of issuing or rather ensuring that the assets that underlie stablecoins are sufficient, they're high quality, you have a high liquidity and are stable. Now, how you actually implement that, again, is ultimately up to the individual jurisdiction. So whilst I think they're doing a good job of, making these or driving awareness and trying to drive, the G20 towards some consensus around the need to do this, I think the big challenge remains, of course, what global standards are we using, and how are these things being implemented jurisdiction by jurisdiction. Just on the standard side, real quick, certainly R3 and others have been involved in trying to drive standards around assets, interoperability, credit risks, and so on. And these things are super hard. You've got academia driving certain things, you've got practitioners driving certain things, and just bringing it all together is really, certainly what I can see, the bigger challenge that we have. Just defining having a definition of what it should look like is I think easier said than done. So yeah, for me, I think the biggest issue is the global standards and the requirements for the quality of the assets remain a big issue.
Now, Gilbert, when I was working on the stablecoins paper, I was quite impressed by the degree of convergence there was among regulators in Japan, Singapore, Hong Kong, Europe, North America on how stablecoins should be regulated. They seem to say we want these things to be issued by banks, we want them to hold this type of thing, and we want you to check that up and have proper governance and so on. They seem to be adhering quite closely to the FSB, the 10 famous FSB recommendations. But what do you think the strategy here is? Are regulators expecting stablecoins to survive, or are they looking to sort of steer it into the banking system where they can be quietly put to death?
I think the first thing is harmonization of policy and regulation. Interoperability is a very key topic globally, but it's not just technical interoperability, it's legal interoperability, governance, business interoperability. How do you work across jurisdictions and across different regulations? We're addressing a lot of those different types of topics and different types of interoperability at ISO, for example, at TC 307. I think what regulators prefer is having the market come up with a solution and then assessing if it's the right way to do it, and then regulating according to what the market needs are. Having worked on the government side, that's a preferred approach. It's less of a directive. It's more of a private-public interaction, consultation, and then recommended regulation. So in this case, the regulators have had many years to consider this, and I think what the preference is, especially with the risks that crypto and bad banking and bad management has brought to the rest of the system, I think they're acting on those risks. And the impression that we're seeing is their approach is to bring in regulated stablecoins in the form of regulated money, which is going to be issued by the commercial banks and regulated entities. And it just brings it all under the same regulatory regime. So from a risk perspective, they're managing that risk in the same way that they're managing different types of money or different types of assets.
Mm-hmm. Well, I'll come back to you, Gilbert, to ask about tokenized deposits in a minute. Before I do, I'd like to share with you this question from a member of the audience. He writes, given the decentralized nature of blockchains and issuance of stablecoins from any jurisdiction, what are your views on the regulation of fiat-backed stablecoins denominated in any currency, e.g. an Australian dollar denominated coin based out of the Bahamas compared to one issued onshore from Australia? I.e. you could have two issues of stablecoin in the same currency denomination, yet one could be regulated, the other won't be regulated, but still be available on exchanges. Now, that's a variant of the reality we have now, if you consider that there are non-bank stablecoins out there who are kind of Keith has criticized me in the past for saying that they're in a regulatory limbo, but it is unclear how they're going to be regulated. Will they be regulated as cryptocurrencies, or will they be regulated as something else? So I think this is a good question, because you could continue to have stablecoin issues of the kind the regulators don't particularly want to see happening. What's your comment on that, Gilbert and Keith? I'm sure you, and Jeet, I'm sure you have points to make on this too. You first, Gilbert.
Yeah, I think issuance is, we saw the reaction from the central banks when a private company called Facebook, later known as Meta, tried to issue a private stablecoin in a jurisdiction. That didn't end well, and there was a surprise reaction from the central banks to not allow that to happen again, just because of sovereignty risk to the system, all the regulatory regimes they have to comply to. Having other entities issue your denomination in your jurisdiction, I don't see that working in the future. And the reason behind that is, for example, in the UK, the work being done on a digital pound is going to be issued by the central bank, and that's the consultation the Bank of England has been doing. But it will also allow a space for commercial banks to issue their own equivalent tokenized deposit or tokenized liability, like a bank pound, for example. But having a UK bank issue $1 in the UK, or a UK bank issue $1 from the UK into the US, that comes back to the policy and the interoperability across jurisdictions. So I think it needs to be worked through, and I don't think they have the answers yet.
Mm-hmm. Keith, any observations on this question? What happens to non-bank stablecoins, if you like, freelance stablecoins, entrepreneurial stablecoins outside the system?
Yes, and I guess particularly, comparing a regulated stablecoin to an unregulated stablecoin, because it's in a jurisdiction which doesn't have regulation, for instance. So I think, as we all know, a fundamental nature of money is, everything is based on trust. And I would imagine that the extent of trust is going to be greater in a stablecoin which is regulated by, reputable agency, in terms of understanding that there are standards in terms of redemption or resilience or reserves or audit or whatever it may be. All of that transparency is going to increase trust, and that trust might manifest itself certainly in terms of the velocity and the amount of transactions, number of transactions being undertaken with that stablecoin, as well as its issuance, the circulation, etc. So I think that will have a significant impact. But since we don't have many regulated stablecoins at the moment, there's probably not enough data around to understand exactly what the nature of that will be. Right.
So in the end, the market, the users will decide which they trust. Ian Hunt's.
I would just like to quickly, Dominic, just add, and completely agree with the trust point, which I think is number one. Keith said. I think the other couple of quick points I'll make is, one is that there's also been a lot of debate in the proposed UK regulatory parameter. If you remember, it actually says wherever you are in the world, as long as you're selling to a UK customer, they want to, or they're proposing to include it. That, for exactly the reason you just highlighted, Dominic, is causing quite a lot of hand-wringing and consternation and thought in the industry as well. Because, yes, that Bahamian bank, which you just described, might be trying to sell a Australian stablecoin and to somebody in the UK. How would that be regulated? How would that be prevented? If so, what would, how would you work through that? I think that's still very much also, I think we can all see situations where anybody can access it. But how do you then capture that will be an interesting challenge as well. And I think to the third point, which I think you touched on in a throwaway comment, you said, bring in stablecoins and then hope that they die. I think I'm a firm believer in the future of the financial services rails being sort of blockchain-y based. Now, to use the analogy, and I think Keith, you used that before, that we're in the 1983 PC stage, let alone the creation of the internet stage. But I think I'm still a firm believer that the future of rails of financial services will be more sort of blockchain-y type rails. In that situation, Dominic, for all the conversation about tokenization, we still need a method to transfer money, be it CBDCs, be it tokenized deposits, be it stable coins. And I would hope that we have a rich ecosystem of such monetary transfer instruments to have to choose from, and that, you know, they don't just die.
Although it's clear from what you've all been saying that actually the regulators have considerable power to decide who lives and who dies. Because if they say this stablecoin is outside the regulatory perimeter, they're asking you as a user to take an awful lot on trust, and you may eventually decide that you don't trust it. Now, Ian Hunt asks the question, if stablecoins are to be useful in digital versus digital transactions, they need to be available on any ledger in any network where people want to use them. How's that going to happen? You're nodding furiously, Jeet. Being regulated is presumably part of the answer to that. Is there anything else to add?
Well, I was going to say, Ricardo touched on that perfectly earlier on when he talked about interoperability, and he talked about the need for, you know, the ability for people to transact or digital to digital entities, if that's the right phrase to use in the future, to actually transact. And I think that is also, again, sort of future sort of peering in the sort of crystal ball. But to me, you know, for us, if we want to get to that sort of financial infrastructure for the future as well, we need that ability which Ian's just touched on. I think that's absolutely critical. The challenge we may have is that so far, quite a lot recently of the hacks have actually culminated or been focused on bridges and things like that. Where, so I think there is you know, it's the weakest link by the looks of things at the minute. So how do we fix that, and how do we make it better? Because I'm in agreement with Ian there.
Yeah, and just to extend that, if I could, I think, you know, first of all, Ian makes a damn good point, and we don't want to build the same silos. You know, not all currencies are able to be used anywhere, everywhere, right? So we have that issue today. You know, we have some exchanges that do a good job of those currencies that are highly liquid and so on. But this is a big drive for the industry. I think Gilbert mentioned, and certainly I've been involved in the last few years around in the interop of stablecoins and money more generally across different platforms, different networks. It's not just technology. You know, on one project, we spent 3 months on the tech and then 9 months on the legal, regulatory, and governance interop. So on the technical side, there are some patterns that are emerging which are really exciting. Asset bridges have their faults. Just talked about that. But the asset bridge is an interesting model, and it has its uses. The other model is cross-atomic swaps that ensure that assets stay within the issued network. They maintain regulatory and compliance regimes, right? You can still control and monitor your asset and so on, but yet you can still facilitate a settlement with an asset on another network. It's not really where we want to get to ultimately, but it's a good first step. There are some other initiatives that are going on, certainly that I'm involved in, to create kind of a virtual layer above all the platforms, and that's what we talk to, this virtual magic layer that does a whole bunch of magic. Maybe we'll get there. Let's think about HTTP and XML and, you know, all the layers that kind of have emerged from TCP/IP that allowed the internet to be what it is. And so we've got a good kind of template and model to kind of draw from, but we're some way away to getting there. So, you know, that's the goal, Ian. We'll get there. We just need a few more years, I think.
If I could just add an extra couple of comments as well. I mean, I think the major stablecoins do not a bad job in terms of the number of chains they support. So I think Tether on something like 14 different blockchains, for example, USDC is available on many blockchains as well. And the other key point is obviously there's a sharp decline in terms of transaction volume as you go from one chain to the other. And therefore, even with the current environment, I would have thought a very large percentage of transactions chain to chain are going to be covered, at least by the stablecoin being able to be supported on a particular blockchain. And the ones that aren't supported, if there is a demand, I'm sure it's going to be in the issuer's interest to be able to support those as well. But I take the point on bridges and interoperability that Ricardo said as well.
Now we're into our sort of last 20 minutes, so I'm very keen to talk about tokenized deposits. And the reason I'm keen to talk about them is that these have emerged sort of quietly through the banking system. We have them issued by JP Morgan, National Australia Bank, ANZ, SocGen, and I think some other banks have now issued tokenized deposits. And I sense that these are an instrument which the regulators prefer to stablecoins. That's just a sense rather than based on any particular conversations with central bankers. But I wonder if any of you think that the regulator quite likes tokenized deposits to displace stablecoins, and secondly, whether they are actually capable of doing that. Are they more stable? Are they easier to use? Can they operate through the existing infrastructure? They obviously can. They settle in central bank money through the usual system, I presume. So what is your view? Do you think tokenized deposits are eventually going to displace stable coins? What's your view, Ricardo?
Oh, well, I mean, I can go first. I'm sure everyone's got an opinion. I mean, tokenized deposits, tokenized liabilities, honestly, I've been scratching my head as to kind of the differences of these things at the fundamental level. And there are differences, but, tokenized deposits, at least the definition we have today, is a traditional bank deposit or other financial asset in the form of a token that's sitting on some kind of a distributed ledger blockchain. So they're not this, I mean, stable coins in our definition provides a broader range of models, but a tokenized deposit is, as it says, it's a deposit, you tokenize it, and now it carries through the traditional banking system. It follows the same regimes and compliance and regulatory and so on. So, can they coexist? Perhaps. Tokenized deposits seem to be a much better model that aligns to the current banking system and compliance and regulatory, as I mentioned. For example, the Bank of Brazil has a really cool model. They've issued, a CBDC at wholesale and tokenized deposits by the commercial banks at the retail end. So kind of a two-tiered model, a hybrid model or two-tiered model. It does differ from the Bank of England's model to some degree. But yeah, certainly I'm pretty excited about the opportunity of tokenized deposits. I'm not, does it mitigate the risk of credit creation? Does it mitigate the risk of, deposits moving away from the commercial banks as folks use CBDCs more and more? Those things are still to be kind of worked through. And then, the big question is, tokenized liabilities versus tokenized deposits. Which one might you use for what? So, there's some homework to be done there, but there's lots of projects going on so far as I'm concerned, so far as I can see, around exploring tokenized deposits as an instrument by the commercial banks to kind of mitigate some of the risks that we've seen in earlier models, such as, a direct issuance of a CBDC, which, by the way, no one is doing, I believe, other than Uruguay, who tried that and failed. So, yeah, I'll stop there.
Gilbert, if we go back to your the BIS flower, which you mentioned a while ago, it strikes me that a combination of a CBDC and tokenized deposits feels a lot more like the existing system, with a central bank currency available to selected players, and on top of that is built a huge pyramid of commercial bank money. Am I right to be thinking that is why central banks and other regulators might favor tokenized deposits over stable coins? It's more like the world they know and feel comfortable controlling?
Yeah, and I think from our experience, we've just spent the last year working with the BIS and the Bank of England, providing the tech for Project Rosalind, and we learned a lot from that. And the main takeaway was, why is a tokenized deposit, tokenized liability, or a CBDC different to a normal pound, to a normal euro, to a normal dollar? And it really comes down to the core function of money today. It's quite binary. It's a push and a pull. The messaging system behind it powering money is very binary. There's not many things you can do with it. But once you have the foundational blockchain technology powering money, you can add conditions, logic, programmability to do different things with money, which you couldn't do before. And I think that's what we're going to see, is the preference to move to a smarter form of money with more functions, more features, to automate workflows, to process transactions based on conditions and logic and all these things to happen, and then execute and settle. It's going to be a bit of a step change in money as we know it. So from the model that the BIS put out, there will be a CBDC within the jurisdiction, and linked to that, you'll see regulated issuers being able to tokenize a deposit or a liability on their end, and having that in the system, because it's a faster form of money. It's a more feature-rich form of money, and it solves a lot of the friction and the pain points that we have today with correspondent banking, with settlement, treasury management, cash, limits. All the friction that we have with payment systems of today. You kind of evolve money to a new form, and you overcome those barriers, and you overcome the friction that we have.
Just before I let you go, on that point you've just made about correspondent banking, for example, would it be your view that tokenized deposits could be a more effective tool than stable coins in payments? And I mean particularly cross-border payments, but also domestic payments. And I raise cross-border payments because that's been a focus of the regulation of stable coins, where regulators have been very enthusiastic about stable coins, has been that actually might make cross-border payments cheaper, faster, more transparent, and more accessible. So they've actually seen a role for them there. Can tokenized deposits fulfill that role as well?
Yes, if the flow on both ends is tokenized deposits, so you're settling, you're issuing, and then you're from an acceptance perspective on the other end. If that's redeemed, and then the deposits on the other end are cash or traditional money, yeah, definitely. I mean, what we're seeing is even, I think it was yesterday, the BIS came out with the unified ledger model, where there's a layer to interconnect and interoperate different jurisdictions. Tokenized money or CBDC can flow between this layer, and then the settlement and acceptance can happen on both ends. So it is a new form of payment rail. It's a new model that we haven't had before, but we need to work on it and see where it goes.
Now, Jeet, I'd like to get your views on tokenized deposits. As I said a minute ago, I think central banks like it. It stays on inside the existing infrastructure. They're backed by the usual lender of last resort and deposit insurance backups, which deposits have. But on the other hand, they are going to be issued by banks. And 3 banks falling over in March this year wasn't a rare event. Banks fall over all the time because of the way that they are funded and structured. We have a fractional reserve banking system, which actually is highly leveraged and rather dangerous. So could you argue that in fact a tokenized deposit might actually be less stable than a stable coin?
It's a tough one, because I think the positives are the ones you just touched on, Dominic, as well, which is that it will have to comply with current deposit regulations, right? So all the requirements for liquidity management, for credit management, etc., Basel III, everything else in terms of regulatory capital requirements and monitoring, it fits in really easily, right? And it doesn't actually need to tweak that model particularly more. But on the flip side, I think you also said, this is a little bit like the establishment sort of keeping it in house or there. I think this is why I made my comment earlier on about a rich ecosystem, Dominic, of payment tools. Where I would hope that what we have is a regulatory landscape that actually drives innovation. So we actually do have stable coins coexisting with tokenized deposits, because it might be horses for courses and different requirements for different areas. I mean, Gilbert also mentioned smart contracts earlier on, in terms of the more usefulness of money and logic. To me, again, I can see the positives and the cons there, right? Positives because I can imagine so many different financial challenges just disappearing because you can make money smart. Think about the amount of hassle that just happens intercompany in large organizations settling intercompany loans, right? If you have smart tokenized deposit type equivalent, you can automate interest payments, you automate tax payments. It's a doddle, right? Makes life so much easier. But on the flip side as well, I do get a bit concerned when we talk about tokenized smart money, because at the end of the day as well, to the point made earlier on, we're still early in our thinking here, and I would worry about the security risk then, how that's mitigated, and how do we actually, manage that.
Keith, do you have something to add on this question of tokenized deposits, which are, whether we draw a distinction between deposits as a liability and other types of liability? These are liabilities of a bank. Are they going to be superior to stable coins resting upon a portfolio of assets which the issuer has chosen? Which of the which the regulators more comfortable with, do you think? Am I right to sense regulators like tokenized deposits despite the slightly different risk they represent?
Well, I wouldn't suggest like is the right word to use for it, but I think tokenized bank deposits, as I think Gilbert and Jeet have already said, essentially are still, largely speaking, regulated in the sense they're just the existing bank deposits in a digital form, and therefore subject to the existing banking regulation, fractional reserves, etc., that regular bank deposits are. Unlike stablecoins, which largely are unregulated at the moment, as we talked earlier, obviously we expect to see regulation coming in. But I think there's another two key considerations that are quite important as far as tokenized bank deposits are concerned. On the positive, the central banks and in BIS in particular, I think, talk about the singleness of money, and that by tokenizing bank deposits, we maintain, in theory, that singleness of money, because a dollar is a dollar, whether it sits in a JP Morgan bank account or as it sits as a JP Morgan coin on a ledger in a tokenized form, because it's just a tokenized representation of what sits on that JP Morgan bank account, as opposed to a stablecoin, which, as we talked about in the past, are not always stable because of the situations that might happen, stress in the market, other issues that might happen, as in the case of Silicon Valley Bank, as we talked about earlier. And that's a fundamental difference, and that obviously affects trust, risk, or the other characteristics. And obviously that does have a major set of questions as far as regulation are concerned. So I think the singleness of money is one important characteristic to think about in this context. The other key point when we're talking about using tokenized bank deposits, for example, international payments, today they are issued by individual banks and there isn't easy interoperability. So if you have a JP Morgan coin, as you mentioned before, then it's fine to provide payments, international payments from JP Morgan client to JP Morgan client, but not easily to a Bank of America or a Barclays client in that respect. So at the moment, I think we're at this position, as you suggested, where we have individual banks that are issuing tokenized bank deposits, which are very good for their own network, but don't really work very well in the broader scheme of things for bank-to-bank transfers as they stand today. And I think that's part of the thinking behind what we talked about already in terms of the concept that both the BIS have been formulating, more recently also the IMF, in terms of having a universal ledger, which takes us on to the regulated liability network, obviously, when you have a universal ledger, both for commercial bank money and central bank money, which would include tokenized bank deposits and therefore provide the backbone to be able to facilitate all of the movement between regulated entities for both tokenized bank deposits and CBDC. Now, that's kind of a long-term vision. I'm sure it'll take a while to get there. And in the meantime, I think there's a lot of interesting questions in terms of how tokenized bank deposits will evolve, given that bank-by-bank kind of characteristic at the moment, versus stablecoins that don't suffer from those questions, but do have a load of other questions associated with risk and regulation.
Right, we're into our last 10 minutes. And I'd like to spend that on what you've just raised, Keith, the long-term vision. And you also brought up that singleness of money. I saw that BIS paper. But from everything we've talked about today, we're evolving a system in which we'll have stable coins, tokenized deposits, and possibly central bank digital currencies are all being used as forms of money. And those forms of money might or might not trade at discounts, undermining or premiums, undermining the singleness of money, and in effect taking us back to a sort of 19th century world where different banks, currencies traded at different values, if you like. So what do we think do you think the central banks yet have, and Gilbert, I'd like you to address this question first, since you've been working with central banks. Do you think they have a very clear strategic vision of where all this is going to end up yet, what they want the money system of the future to look like so that it works well for digital e-commerce on a global scale? And what about that singleness of money? Are they concerned about money fragmenting?
So the central bank's mission is always monetary policy and resilience and stability of the system, and that hasn't changed for centuries. So for the Bank of England example, they've gone back to the Bank Charter Act, I think it was 1844, I think it was, to decide what are the requirements for a CBDC, and the same requirements applied back then for banknotes as they do to CBDC for business and consumers. So what they're looking at is a digital form of cash. So from an acceptance perspective, it's the same as cash. It has the same issuing and the backing of the central bank, but it has a digital life. So it's able to do things that cash couldn't do before, which we've covered very briefly. But the whole policy behind why they're doing this and why there's a evolution of money, it's to increase innovation, give more access to central bank money, to create competition, new types of products, new types of services, and a bigger ecosystem that is really fit for the next generation of payments and the next generation of money. So they see money evolving into kind of and the deputy governor's mentioned this as well, kind of like an app store. So you can create new types of products, new types of banking, financial, lending, whatever products based on central bank money that you never had before. So their view is maintaining stability, but increasing innovation and growth through better competition.
Yes.
Let me. I'll come back to you, Ricardo. But Jeet, what is the future of money in your mind? Is it clear yet?
No, I don't think it is. To me personally, I think I'm in Gilbert's camp about the point about the App Store, and I think what we're going to do and what we're going to use and the services that are going to come out still haven't, dare I put it, been thought about yet. I think we're starting to see an inkling of them, Dominic, in some of the DeFi spaces in terms of how some new ideas of how financial instruments could evolve, if I could put it that way, right? And there's some interesting insights coming out from the DeFi space. Whether we like them or not from a regulatory perspective is a whole different conversation, right? But there's some interesting innovation going on there. And I think we're still early on, to the point Gilbert made, as to how that evolution is going to go. So I think we've got a long way to go, Dominic.
Mm-hmm. Ricardo, we do, Jeet has just referred to institutional DeFi. We see some very interesting experiments being conducted in Singapore in particular with JP Morgan and DBS, with the engagement of the central bank there. Is that where the future of money is being manufactured?
Yeah, I mean, it's hard to tell. I think, that's that term is, institutional or regulated DeFi is really interesting to kind of unpack. The last I looked, there were just under 300 different apps within the Ethereum kind of network around DeFi, lending, borrowing, insurance, trading, a whole bunch of different types of financial kind of products. So to Jeet's point, I think we can certainly look to that space to get kind of some inspiration as to what it might look like. But in terms of the future of money, coming back to what Gilbert said, I think stability, ease of use, easy interoperability, the transparency, regulatory and compliance kind of underpinnings. I think those things won't change. Certainly, they may be even elevated. So we'll see. It'll be more transparent. Maybe these instruments will be kind of more interoperable, so to speak. But I'm particularly excited, and certainly some of the folks that we've been working with, the Bank of Kazakhstan, for example, their drive is to lay a new substrate in order to allow new business models and these new kind of apps just to kind of follow the tone and follow the narrative there to emerge. And we don't know what those might be. But yeah, institutional DeFi seems to be kind of the immediate kind of space for us to draw some inspiration from.
Keith.
In terms of the future, the BIS, I think, has done a super job in terms of laying down their vision in terms of what the future nature of money will be. And anyone who hasn't seen it, I do suggest you read the reports that cover that. But I think the challenge remains in terms of will that solve the requirements that everybody has? And I'm mindful of CBDC, where, for example, as we know, the UK is coming to the end of a consultation process. But the question of a CBDC in the US market has been a very thorny issue. We've had it being banned as an idea in Florida, for example. Some parts of the political establishment are obviously very much against CBDCs. So exactly how far that central bank minded view of the universal ledger, for example, being able to have a harmonious relationship between tokenized bank deposits for commercial bank money and CBDC for central bank money. To what extent that will actually be, well, I'm sure it can be practical, but obviously a very strong, long journey to get there. But I think some of the suspicions that will arise from the crypto community and other parts of the broader population will mean that stablecoins and non-institutional DeFi obviously will continue as well in parallel. So I think it's going to be particularly interesting to see what the interplay is going to be between the two. I don't think either one is going to fail in any respect, but I think they'll both be very present, and it's going to be really interesting to see how that evolution happens in practice.
I even noticed that painted across one of the overhead bridges on the M1 this last weekend when I was driving. No CBDCs.
Exactly. Yeah, so that's part of the consultation.
Yeah. It's good to know that they're worrying about CBDCs up in Luton and Bedford, along with the rest of us. Our time is up, but I'd like to leave our audience with a simple answer, I suppose, to the question with which we began. What are you doing about regulated stablecoins? Like, what should you be doing about regulated stablecoins? So my question is, do stablecoins have an assured future as a form of money? What's the view of each of you? We can start with you, Ricardo.
Oof. Wow. Honestly, I'd say to you that it's too early to tell. Regulation certainly is creeping in. We're already starting to see kind of the gamut of stable coins being left out. So the algo side. So, it's too early to tell. I'd be really depressed if there wasn't some form of stable coin that survives long term, right? So, what we don't want, and I think Andrew Bailey said this at some point, he was like, hey, we all live on Earth together, so we're all susceptible to compliance reg. But the job of the regulator is not to stop innovation, but to provide the guardrails to allow it to flourish. Mm-hmm. So, that's what I'm hoping for. Too early to tell.
Jeet, what's your answer to that question? Do stablecoins have an assured future as money?
I hope that they do, Dominic, because I think they provide some spread of risk potentially as well through what we touched on earlier on. But to Ricardo's point, I'm very much in the camp of Ricardo there.
Mm-hmm. Okay. Keith, what's your answer to that question?
Yeah, very similar view. I think there are a lot of factors like regulation in particular, and I think the question of the alternatives, how compelling and attractive will the alternatives be, given where CBDC is going, given where tokenized bank deposits are going. And I think it's the combination of those factors will be the answer to the question, and my crystal ball isn't clear enough to answer the question and knowing what those factors will be.
Gilbert, last word from you. You have a very clear vision, I think, of the future of money, its characteristics. Stablecoins are going to be part of it?
I think a form of stablecoin will, yes, definitely. And it really is there to solve a pain point in the financial system. And maybe it's just for P2P payments, maybe it's just for low value payments, maybe it's for cross-border. We don't know yet. But I think the answer is that the other question is who will be issuing that stablecoin? And the answer to that is most definitely someone who is regulated in line with the jurisdiction, complies cross-border jurisdictions as well. So from a regulatory perspective, they're accepted to be a form of money, but it also would have to work with traditional dollars and pounds and euros, but as well as CBDCs or commercial bank money as well.
And all those forms of money are going to be programmable, right?
If they're DLT based, they'll have the benefit of the features of DLT, and there'll be smart money or programmable money. Yeah.
Okay. With that, I think we must stop. I'd like to thank our panelists, Ricardo Correa of R3, Gilbert Verdian of Quant, Keith Baer from the Judge Business School in Cambridge, and Jeet Singh from EY. Thank you also to you, the members of the audience, for your questions, your comments. One final reminder, you can download our paper on the regulation of stablecoins. It's on our website and very easy to access on the home page. But with that, it's goodbye from the five of us.
Thank you.
Thank you.
Bye-bye.
Thank you.